Tim, with the stock market run up that we've had, specifically in the S&P 500, I've had a lot of clients wanting more, right? They feel like they're missing out. They have that FOMO. What would you say to people that have that feeling, that come to us as advisors and say, we want more of that?
Yeah, I mean, have we seen that in spades recently, that this 10 companies or fewer, these magnificent 7, that now represents over, 30% of the S&P 500. That's a lot of exposure. We know one of the core rules of investing is to diversify. And the success we've had as investors is leading us to be less diversified. And so I think it's more important, maybe now so than ever, to make sure that when you're looking at your portfolio, you've got some things that are sitting outside the S&P 500, because it's very easy to just rest on your laurels, let your winners ride, be convinced that what has happened over the last 3 years, 5 years is going to continue to the next 3 years, 5 years, 10 years. But I think it's important to remember that there's a reason we have these other asset classes. There's a reason we have small cap U.S. stocks. There's a reason we have non-U.S. stocks. And it's because at some point in time, these 7 companies, these top 10 companies in the S&P 500 are not always going to be the winners. If we look back, as a matter of fact, if you look back 30 years ago to the S&P 500, you would have none of the 10 holdings today. So kudos to the S&P 500 for picking that up. And as an S&P 500 investor, you were able to participate in the growth of those companies. But at the same time, they're not, 30 years ago, what were the leaders? It was GE. Remember, Jack Welch could do no wrong. It was a very different environment. And the leaders from 30 years ago, even a decade ago, are not going to be the leaders 10 years from now or 30 years from now. And yet you need to be successful as an investor, not just today, not just this year, but the decade and ensuing years. And so it's going to be more important than ever that you're complementing what you're doing and staying diversified outside of just the S&P 500.
And Tim, I've heard you mention the phrase numerous of times at client events, on webinars, that if you're the average investor that, just buys your S&P 500 index fund, you may not be as diversified as you think. Can you expand on that a little bit?
Yeah, the S&P 500, again, great. It's market cap weighted, so it's designed to sort of represent the broader U.S. stock market. But at the end of the day, it represents 500 companies. 30% or more of this index is made up of just 10 of those companies. So we know.
So Tim, I want to stop you there. So you're saying 30% of the S&P 500, which is the 500 largest companies in the U.S. weighted accordingly, is 10 of those companies.
Yeah, that's right. And so 490 of the other companies, and then all of the other publicly traded companies, and then all of the non-U.S. publicly traded companies, and then all of the companies that are privately held aren't represented in that investment. And we've been fortunate that it's been such a strong run. We've been very fortunate, and kudos to those companies for driving these great revenue growth, earnings growth, and share price growth. But again, we cannot count on NVIDIA and Apple and Microsoft to carry us for the next 30 years. I think they'd like to be able to do that for us, and we'll cheer them on. And being diversified outside the S&P 500 does not mean you sell the S&P 500 and get out of those stocks. It just means that you need to watch your exposures, understand that you may have a little bit more risk in that investment today. It is not as diversified as it was a decade ago. And the proof is that it's been a great performer, but it's not as diversified. And not as diversified means you've got a little bit more risk there.